Now, what I don't appreciate is what's going on here in regards to cake stock. So once again, up to about an $85,000 position in the public account, $15,000 plus. I also have a big position in my Patreon portfolio. I own shares of this in my private portfolio. So it's a very good stock for me. It's been treating me very well, even very early on in the investment. And then it's up a bunch after hours. So, I'm probably up many thousands of dollars more after hours if you add up all my different portfolios. But I'm not happy because here's what's going on here. Here's what's going on. Activist investor urges Cheesecake Factory to explore a potential split. Houston-based activist investor JCP Investment Management is urging Cheesecake Factory to explore the possibility of creating a separate public company by spinning off its 3 smaller brands, according to the Wall Street Journal on Monday. JCP Investment Management, which has built roughly a 2% stake in Cheesecake Factory, has privately told executives that North Italia, Flower Child, and Culinary Dropout brands would be better off as a separate company, Wall Street Journal reports, citing people familiar with the matter. Obviously, Cheesecake Factory is up a bunch after hours because people are thinking, well, if they split up Cheesecake, maybe there's a lot more value. First off, that's true, 100% true. In the very short term, there would be a lot more value derived from splitting Cheesecake Factory away from these other brands. Short term, yes. Like if we're just talking like money in my hand today, yes. Cheesecake Factory is a significantly undervalued asset. It trades at a forward P of somewhere in the 12 range if we were to check on 1000xstocks.com right now, right? That's insane, especially considering this is such a stable restaurant chain, plus they have these major growth vectors of the company. So there's no doubt, I agree with JCP in respect of like way more value derived in the short term if they split off Cheesecake Factory, but that does not mean that's the better long-term decision. As somebody that's thinking about stocks I want to own for many years to go in the future, I don't like this at all, just to be quite frank, right? Now, there was a song playing on my phone. It was a perfect song. It says, "Nobody does it better." Do you know that song? Nate Dogg, Warren G? You don't know about that. But anyways, okay, listen. It's insanely hard to create one restaurant that is good quality and successful. I mean, insanely hard. I'm just talking one location. Ask anybody that's from the restaurant business. They're going to tell you it's ridiculously difficult. Now, when you talk about expanding restaurants all over the United States of America, or dare I say all over the world, it's a whole other issue. It's insanely hard to do this. This is why companies like McDonald's and Starbucks are valued with such unbelievable valuations on them, because they're able to basically, if you go to McDonald's in Kansas, it's going to be likely the same exact quality that you would go to a McDonald's in Seattle. Like it's the same thing. And that's incredible, but it's extremely hard to do. Cheesecake Factory's done this over time. If you go to Cheesecake Factory in Charlotte, North Carolina, it's going to taste the same exact as the Cheesecake Factory you go to in Henderson, Nevada. It's the same thing, right? That's ridiculously hard to do. And that's why there's actually very few big restaurant chains that are super successful and super profitable, because it's so ridiculously hard to do, because all it takes is one night of bad service and you might have just turned off your core clientele base, right? So the moral of this story is Cheesecake Factory knows how to do this. They know how to expand restaurant concepts all over even the world, because there's Cheesecake Factories even outside of the United States, right? And they know how to do that in a very successful manner, right? And so they're now doing that with North Italia. They're now doing that with Flower Child and Culinary Dropout and their other brands they own, because they own other brands other than that. And so they're pulling this off, and that's ridiculously hard to do. And trust me, like FRC, Sam Fox, he would have, if he really wanted to go crazy with those brands and expand them all over the United States, he could have done that, right? But he understands, as a restaurateur, how hard it is to keep that quality high. You got to have a whole management team, and you got to have managers on managers on managers. You got to have managers of market. I know, just coming from Quick Trip, how high our standards were in the management levels. You had the assistant managers. Above that, you had higher level assistant managers, then you had higher level assistant managers, then you had your store managers, then you had your training managers, then you had your supervisors, right? Then you had your district managers that were usually just like, basically they had one state to worry about, right? Then you had your regional managers, and then you had managers over there. You had all these chains, so everybody keeps everybody on their toes. So you keep everything at a high level and no one can slack off, or there's like a next manager is there to say, what are you doing here, right? So there's like a whole chain. That's difficult to do. And you've got to have all those managers be very high, very high quality. It's ridiculous. It's a whole process. It's insanely hard to do. Trust me, if you've been in the business of expanding locations over time, you know it is, right? It's ridiculously hard. It's more than just opening it up and saying, here's our new place and it's got the same name as all the other states. No, okay? So that's part one. Part two here is Cheesecake Factory is an absolute cash flow machine. This company produces incredible operating cash flow, right? It's a profit machine, this company. And so guess what? All that operating cash flow this company's pouring off quarter after quarter after quarter, year after year after year, that money can go into expanding North Italia locations, Flower Child locations, other concepts, and they don't need to worry about issuing debt or anything like that. And then they also pay out fatty dividends as well, right? And if they took away the dividend, they could expand locations even more if they really wanted to, right? But all that cash flow. So then the company doesn't have to worry about raising debt or anything like that. They're just able to produce these incredible profits and pour them into these locations. Then these locations become profitable. And a lot of times they become profitable actually rather quickly. And then they start producing more cash flow so they can expand more locations. Just keep like the locations, just being spread more and more and more, which is incredible, right? And it's a whole system you have to for these locations to be successful. Because if you look at North Italia reviews, just about anywhere they open a North Italia, it's usually like 4.4, 4.5, 4.6, 4.7. That's ridiculously hard to do. Once again, ask anybody in the restaurant industry how hard it is to keep your reviews very high like that. They pull it off because their quality is so good, service is so good, anywhere they open, right? And so this is the cash flow machine. So when I see a Cheesecake Factory restaurant, I don't see what a usual person sees. A usual person sees a restaurant there. What I see a JP Morgan Chase there. I see a bank. I see an ATM, a cash flow machine pouring off money to then expand into these other brands. That's what I see. Now, do I think Cake could do a lot better job of explaining their value proposition to Wall Street and to investors? Yeah, absolutely. I think a lot of people just hear Cheesecake Factory and they just think of the Cheesecake Factory concept and they have no clue about North Italia or Flower Child or any of these other concepts. Otherwise, Cheesecake Factory's forward P right now would easily be in the 20s. Easily in the 20s right now. Wouldn't even be close. It would be like probably maybe 25, 30 forward P on this one if they really understood that. But I don't think the management team's maybe done a good enough job explaining that to Wall Street. So which maybe means they got to put more resources into investor relations, into getting Wall Street to understand what's going on here with the company, why it matters, how big their opportunity is here, right? And then people will be getting to understand, okay, this company deserves a lot bigger valuation than, let's call it what they've been putting on with the company. So, that's my opinion in regards to this one. I'm not a happy camper if they try to split this one off. They need to keep it all as one company. It works perfect. Like, keep doing your thing, Cake. I hope these investors can bring more attention to Cheesecake and then kind of take things from there, okay? Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Cheesecake Factory. It's a $42 stock here today. The stock price is up over 21% so far year to date. Now, in regards to the stock, this is what I'm building out significant, right? This is a public account you're looking at, which is available for everybody in my private stock group to see this particular portfolio, right? Now, this portfolio, I have my big six, right? Which are Meta, Tesla, PayPal, Palantir, Amazon, Elf. All those have gotten me great gains: $776,000, $253,000, $56,000, $188,000, $86,000, $105,000, right? Cheesecake's now sitting on a $15,000 plus gain that does not include dividends I've received from Cheesecake as well. It's now my 7th biggest position in that portfolio. My plan is, in regards to Cheesecake Factory, build the position even bigger. I'm not done buying this one. It's still a steal deal, and I mean a steal deal. So when it comes to Cheesecake Factory, for each share you own of Cheesecake Factory, they pay you about $1.08 per year in dividends, right? Now, keep in mind, the company had been raising their dividends, pretty much year after year for a while. They went from 29 cents to 33 cents, then up to 36 cents, and then Rona came, right? And their restaurants had to be all shut down. Then when they were allowed to open again, it had to be partially open, so their cash flows were affected very negatively. And so Cheesecake, just like Wynn Resorts, had to yank their dividend, right? They took it away. Well, then they were able to finally bring it back in May of 2022, and they brought it back with a 27-cent dividend. They've consistently paid that here, even through the high inflationary cycles and everything they had to go through in regards to that, right? Now, they should be able to up that dividend quite significantly, okay? And here's why. If we look at the next few quarters, they're talking about 49 cents of EPS. So if they're paying 27 cents per quarter, that's around a 50%-ish, payout ratio, roughly around there, right? If we look at the December quarter numbers, that's around a 30%-ish payout ratio. If we look at the March quarter, 35%-ish payout ratio. And then if we look at the June quarter, that's under 25% payout ratio for the company. So there's a lot of room to raise this dividend over the next few years, significantly. Now, additionally, the stock is likely going to perform tremendous. I mean, absolutely tremendous over the next few years. This is not just a story of making a lot of dividend money and making more dividend money. This is a story of making great share gains, because I see a day when Cheesecake's $100 plus stock. So if we look, they're about to go into a cycle of growth acceleration based upon what analysts are expecting here, from 4.3% to 4.7, 5.33, 5.37, 5.64, 5.96, 6.37. So we're likely going to see this company's growth accelerate quarter after quarter after quarter, which is a very exciting cycle to go through when your growth is just going higher and higher and higher and higher, especially when it's expected for many, many quarters to go in the future in regards to Cheesecake. Now, the other thing with this stock is it's dirt cheap, especially given the growth opportunity for this company. Given the dividend yield on this one, it's a dirt cheap stock. I absolutely love it. The risk reward here is so attractive, it's ridiculous. Hey, I want to thank you so much for watching that clip here today. I hope you really enjoyed that one. What you're looking at right now is 1000xstocks.com. 1000x does not just show you a billion different metrics that are completely irrelevant. It's curated, mandatory metrics, advanced metrics, curated for long-term investors, not for traders, so you can understand a company on the highest level possible, how it operates, and most importantly, making judgments on whether you want to invest capital into a company or not. Understanding the upside, the downside with companies. Is that company worth our investments, or shall we keep our hands away? So how you can access 1000xstocks.com is you can go to the description area of this video, or you can go to 1000xstocks.com, apply for access to the service. Alrighty, next one up here. Earnings expectations are way too low, and markets will swing higher.
S&P could hit 6,000 before the election. Joining us now is HSBC Chief Multi-Asset Strategist Max Kentner. So you see the good times going here. Why?
Yeah, good morning. The good times still rolling. I think when we look at the earnings expectations for the S&P 500, when we exclude the seasonal bump in utilities, for example, actually consensus expects earnings to contract quarter on quarter in the third quarter. In a quarter where, for example, the Atlanta Fed's GDP now is saying that real growth has probably been 3.5%. So we're talking sort of nominal GDP growth around 6% most likely in the third quarter. And yet consensus expectations are for a decline, for a sequential decline in earnings expectations. So in other words, put it simply, earnings expectations are way, way, way too low, way too pessimistic. And I do think that means the next couple of weeks, a bit of an upswing, particularly driven by the cyclicals and stocks, a bit of the reversal of what we had in Q3, not buying the bond proxies, not buying the defensives, but really rotating into these cyclically and economically sensitive stocks.
I'm just thinking about what could go wrong in this kind of very benign economic environment, Max, and that is we've seen this creep up in bond yields as the economy has come in strong, so that's good news, but not good news if you were hoping and praying for Fed rate cuts, which might start to get more priced out.
Yeah, 100%. I think for now, it's still the good kind of reflation. For now, it's still the good kind of increase in yields. There will come a point, I think, where that will flip, just like we had in April this year, just like we had in the fourth quarter last year. Remember sort of September, October last year when yields hit 5% on the 10-year, or like we had a couple episodes in 2022. The point now is we need to try to figure out really that threshold, that point when it starts to become painful for equities, for credit spreads, for emerging.
Expecting 2 more rate cuts this year, 25 basis points each. I'm not there. I expect 1 more rate cut this year, 25 basis points. So we definitely disagree there. S&P could hit 6,000 before the election. I mean, that's only 2.5 weeks from now, right? Okay, let's just throw darts at a dartboard there. U.S. is absolutely not heading into a recession. Well, yeah, I would say the next, 6 to 9 months look pretty good, but I think there's still question marks about 26, 27, what happens there. Keep an eye on home building numbers. That's going to tell you if some problems are going to come down the road or not. So, yeah, we're looking good in the short term, right? Like the short term's looking good. Unemployment's in the 4s. Real wages are picking up. I think that should be good for spend for the next 6 to 9 months. So, in the very short term, I think we're still good here, right? But yeah, the jury's still out on soft landing or not.
It's really for risk assets across the board. Now, we do think is what we call the danger zone. We analyzed that at the start of the year, and we do think that is more likely around 440 to 450 in the 10 years. So there is still around 35, 40 bips to go until really that pain zone, that threshold where really it will start to suffer until that really arrives. So there's an awful lot of room still really for equities to go higher until valuations will start to feel a pinch.
Coming into October, Max, one of the running themes was that people would start putting in hedges, trying to manage election volatility. VIX almost back to 18 today. It's going to be the lows for the month. Is everything already in place?
Yeah, I think everything is in place. In fact, I think I would argue part of the reason why we still are so bullish, particularly on U.S. equities, is because sentiment and positioning are still low, right? Just like you were saying, the narrative was, we had all this carry trade unwound in August, and, the labor market was signaling a recession. On the back of that, people were de-risking, they were degrossing their equity risk, they were really getting out of equities, out of risk assets, going into duration, going into buying treasuries, into buying bonds, and really fleeing for safety there. And then obviously we had this narrative around weak September and October seasonality, perhaps exacerbated by election uncertainty. We never really bought into that because sentiment and positioning as a result of all these worries continues to be really low. And as a result, the equity market just continues to climb that wall of worry. And I think just to give you a number, when we look at our own sentiment and positioning indicators, which is an aggregate of 19 different measures, that still on aggregate is closer to a buy signal at the moment. It's closer to a buy signal than a sell signal, even though we've got the S&P at an all-time high. Absolutely nuts. That's crazy. We've never seen that before, at least not since we've been tracking that sort of aggregate sentiment indicator. Despite an all-time high, we're still closer to a buy signal. That's not the time where you want to be throwing in the towel.
So in terms of what stocks have still major upside ahead in this market, my opinion is where the real biggest opportunity. So first off, big tech. Let's talk about big tech. Big tech, I think, still has some upside potential over this next, we can call it 6 months or so, 6 to 9 months or whatever. Those stocks, I would put a lot of them in either the 5% to 25% category, meaning like some of those stocks I think might move maybe upside of 5%, maybe into the 10% range over the next 6 to 9 months. And there's others that I think are going to move more in that 20 to 25% range over this next number of months, right? So big tech is not the biggest opportunity. Even for some of those stocks, I expect to actually move quite heavily over the next few months. The biggest opportunities, in my opinion, are Russell 2000. I think smalls are definitely positioning well, especially if Trump wins. I think I think there's going to be a lot of euphoria around Russell. So I think those ones still have a lot of fun to be had. And then a lot of the dividend and value stocks, that have been laggers for the last several years, just to be quite frank, I think there's a lot of upside momentum in those names. I think you'll see stocks like Nike, which is a stock I'm buying heavily right now, right, come back to life in a major way. I think PayPal has a lot of room to run. I think SoFi has a lot of room to run as there's kind of a better feeling out there in regards to consumer being in a better spot, right, because we're such a consumer-driven economy. So when the consumer is getting nailed, There's a very bad sentiment out there, right? But when the consumer's feeling a little better, there's definitely a better feeling out there, right? So, I think it matters. I think the election matters actually a lot to the market in the short term. I think if Trump wins, that matters significantly to the market in the short term. There's just a clear difference in how people view Trump versus Harris in regards to economics, right? And so if you're talking about like even people that are a little more maybe on the Harris side, even a lot of those folks, even though they might not want Trump because of some other things, right? They kind of look at him and feel more comfortable economically, right? And there's just a better feeling there from a money standpoint, right? Business standpoint. So yeah, well, we'll see how it all shakes out, but the short term looks kind of okay here, but I think there's still everybody wants to crown it soft landing. We don't know yet. We haven't reached that stage. The Fed just cut for the first time. You can't call a soft landing or not a soft landing until the Fed's done many cuts. Until the Fed, until you're at least a year to 2 years out from the first cuts, then we'll know. Talk to me in 2026, and we can call it a soft landing or not a soft landing, right? Keep a very close eye over this next year on new home order numbers from Toll Brothers and all the other home builders. How are those numbers looking? Very important next earnings season for those companies, right? And then, mortgage rates have gone up recently. That's not good. And I'm seeing more inventory start to pile up in regards to the housing market, which could lead to actually deflation in the housing market, which is another thing that's good for the consumer. But if suddenly you have home orders dry up, that's going to hurt the economy significantly, way more than a lot of people realize. And that's where I start to kind of figure out like, could the economy be in some trouble maybe 26, 27? But for the next bit of time here, I think we can party a little bit, right? Big tech's looking good. Russell's going to likely come back to life. Consumer in a better spot. So we can party for a little bit in the short term, but I think the jury's still out if we look a little further out. People have been off in regards to their timing significantly in regards to this market and kind of their expectations about when the crash is going to happen, when the economy is going to go bad and those sorts of things. They've been way off in regards to all that. And we know that certainly, right? Because the call was for 2022 massive recession, then it was 2023 massive recession, then 2024, right? And people kind of got to keep pushing this out. I think if Trump wins, you have debt euphoria come in the market, consumers in a better spot, inflation's dead, right? And we're going in a Fed cut cycle. I think you could have some euphoria that really comes over this next 6 to 9 months, and I think you could eradicate basically everybody that's got the bearish case, right? I think you could eradicate the bear case completely. I think you could eradicate all these folks that the recession. And that's a moment I get scared. That's a moment I get really worried. And that could come in the next 6 to 9 months. So after that, then I'm like, ooh boy, okay, no one's calling recession anymore. No one's calling bear thesis. Everybody's feeling good about the market. Everybody's feeling like, okay, it's an investable time. That's when I start to get concerned. And especially if I get confirmation that maybe inflation starts spiking back up in the summertime next year, along with, let's say, new home order numbers that are weaker, then we can talk. But until that happens, party on.